Great. Just about 2 more minutes and we'll get started. Thanks, folks, for dialing in. We have a large number of participants. I'm just waiting as more of you join on the line. Or ICCR. My name is Nadira Narain, and I am Program Director of Strategic Initiatives at ICCR. We are excited to have so many of you on the line today representing both ICCR members and Principles for Responsible Investment, or PRI, signatories. Today's webinar will highlight the history of institutional investing in the commodities market, including new research noting the effects of passive investing and potential legislative changes. Our speakers will be answering questions midway through the presentation and will also address questions at the end of the presentation. So whenever a question comes to mind, please type them into the question box on your screen. And I'll turn it over now to Kate Walsh with the Tri-State Coalition for Responsible Investment to introduce today's webinar and the speakers we have on the line. Thanks, Kate.
Great. Thank you, Nadira. And thank you to the UNPRI for allowing ICCR to host this webinar regarding commodities. As Nadira mentioned, I'm Kate Walsh. I'm a consultant to the Tri-State Coalition for Responsible Investment based in New Jersey, and we are a member of the Interfaith Center on Corporate Responsibility. And as a way of introduction, I wanted to explain a little bit about ICCR. We members seek a global community that's built on justice and sustainability through transformation of the corporate world, from mitigating environmental and social impacts of the extractives industry to calling for greater access and affordability of healthcare services, and to advocating for supply chain accountability that eradicates the specter of human rights violations. ICCR has an enduring record of influence. Our faith-based members include pension funds, endowments, hospital systems, religious orders, and communities whose collective investments exceed $100 billion. And in addition, our network of associate and affiliate members include major public pension funds, investment firms, labor unions, and private foundations. For those of you joining us today who are not ICCR members, we would certainly welcome your interest. To lead our webinar, I'm honored to introduce both Michael Masters and David Frank of Better Markets. Michael Masters is founder and chairman of the board of directors of Better Markets, a Washington, D.C.-based nonprofit, nonpartisan organization dedicated to policy and financial reform. Mr. Masters' growing concern for the far-reaching, harmful effects of unregulated derivatives markets inspired him to establish Better Markets in 2010 to promote transparency, accountability, and oversight in the domestic and global capital and commodities markets. As a highly regarded expert on commodities and financial regulations, Mr. Masters has testified before many congressional committees and government agencies. He has also addressed consumer, corporate, and investor and academic groups, as well as appeared in media outlets around the world. In addition, Mr. Masters is founder and managing member of the Atlanta-based investment firm Masters Capital Management. David Frank is research director of Better Markets. Mr. Frank has significant experience in the financial markets and has had extensive training in statistical analysis. In 2009, Mr. Frank coordinated research into the study of how commodity markets and capital markets function. He meets frequently with U.S. and European financial regulators, as well as members of Congress to discuss these topics. He has lectured in the United States and his native UK on market function and structure and on regulatory frameworks. And to begin, I'd like to hand it over to our presenters.
Well, thank you very much, and I'm happy everybody is here. This is Michael Masters, and I'm going to talk for a little while, and then I'm going to hand it over to David. And I guess we'll just jump right into everything. So basically, I'm going to talk about commodity investments, talk about a brief history of it, and then talk about the notion of investment itself, what that means, and also the notion of principles investing, and maybe the most or a more efficient way of investing rather than some of the ways that have been marketed to large institutional investors by agents. And so, Mary, if we could just move forward to the next slide, please. This is basically a slide that addresses a brief history of commodities as they've been promoted to institutional investors as a new asset class. And it's interesting as people in the financial industry are marketed anything, it seems like the financial industry likes to call every new idea that they're marketing an asset class. And I'm not sure everything really is an asset class. I think that there's other ways of considering investments, and even perhaps a step back needs to be taken in terms of what is the nature of investment and what is more of a speculative endeavor. But at any rate, in 2004, it seemed like the marketing of commodity derivatives, in our view, probably because of the bear market in equities in the early part of the aughts decade, I think contributed to this, and I think people were looking for other avenues for capital appreciation with theoretically lower correlation, and so I think that's really what got institutions to really consider this idea of investing in commodity derivatives through various structures, whether that be total return swaps or commodity ETFs or notes, funds, and so forth. And as this investment happened, it's probably not surprising from a common sense standpoint that the markets themselves change, both their previous correlative or anti-correlative nature, and also the characteristics themselves of how they actually traded around information and so forth. It's pretty clear that more noise was entered into the system through this investment process. Let's go to the next slide, please. And clearly, there were two really ideas that were promoted to investors from agents, large swap dealers, and so forth. Number one, that commodity derivatives really provided a pretty significant diversification and correlation benefit, and then secondarily that there were absolute return benefits as well. So let's look and see what's happened subsequent to the larger scale investment into commodity derivatives. Next slide, please. And here's a chart of the GSCI, which is the Goldman Sachs Commodity Index Total Return, which is if someone has a commodity index swap, then they generally have them based on the GSCI or the Dow Jones UBS, one of the two benchmark indexes, and they're typically done in swap format, and they get the total return of that swap. And as funds have allocated to commodities, you can see that the correlation has changed significantly. There's been periods of time when correlation has dropped, but certainly for the last 6 years or so, less so this year, but certainly more prior, commodities have actually been much more correlated than they traditionally have been, and for a much longer period than traditional capital assets. Now, there's some other issues there. We certainly don't think it's just the activities of institutional investors. There's other economic issues out there as well, but we think that there's certainly one factor of the increased correlations has been the large-scale investment by capital markets investors into these kinds of products. Next slide, please. And if you look at the absolute return, if you look at, this slide goes back to 2007, and these are the two major benchmark commodity index investments with $1 billion allocation. They had a large move up and then a subsequent bust, and subsequent to that, they haven't particularly had very good returns. In fact, negative returns over that period of time, which really, in our view, is a function of a variety of things, which I'll talk about. But it's interesting that the idea of commodity indexing itself, that really the two pillars, the idea of correlation and then absolute return, both of those haven't seemed to work out very well for the last 6-7 year period at any rate, and we'll just look at some other longer term dates as well. Next slide, please. And really, I mean, this is where I want to introduce this idea of speculating in the fruits of production versus investing in the means of production. And classically, large-scale investment, institutional investment has been made in the sense of in the means of production. I mean, people would invest in an enterprise, and that enterprise would go and create something. As it relates to commodities, they would perhaps, for instance, energy. You drill up oil, you take it out, you refine it, and then you sell it to the consumer. That's what typically investment had been in the past by institutions. This was really the first time where you had large scale, and that's the key notion there, large scale investment into sort of the fruits of production or derivatives which represent the fruits of production. So you had a situation where people were actually buying, rather than the means of production, they were buying the inventories themselves. Commodity derivatives really just represent inventories. And I think this is a really key concept because it's very unusual for someone to invest in inventories versus actually the means of production themselves. It almost, because investing in the inventories, it's really a misnomer. One cannot really invest in inventories. One can buy them at one price and sell them at a higher price, but their only ultimate value is in consumption. And so there's no investment merit in a bushel of wheat. It's simply its ultimate value is in its consumption. And so one can speculate. One can buy at one price and sell at a higher price, but the whole idea of investment is sort of turned on its head in actual investing in the or speculating in the inventories. Next slide, please. And here's an alternative, and this is a pretty simple alternative that you could construct alternatives that were much more customized and much more designed to a specific allocative strategy for a given institution. But this is just this is a performance of an index investment since 2007 versus commodity-related equities, a portfolio of those, which was actually on the last slide, the CRX index. And one can see that the returns of investing in the means of production over this period of time have been much greater. And I think that there's a couple of reasons for that, which I'll go into this. Notably, next slide, please. We just used oil here, but we could have used other commodities. WTI is West Texas Intermediate crude oil, which is the U.S. crude oil benchmark, and very actively traded. What's happened is the WTI price has gone up. The revenues available to energy producers have increased sharply, and that's actually what one wants to happen is is to benefit from that production, production times price. And I think to a certain extent investors have been sold this idea of, you can bet on just the price, but actually it's better to invest on the price and the volume, because even if the price falls, if you can benefit from increased volume at a lower price, and you can still have a solid return on invested capital. And that's, I think, the difference in terms of investing actually in production of commodities versus actually in, speculating in sort of the fruits or the commodities themselves. Next slide, please. And clearly, if you look at production and you actually look at energy production, you can see that this is the S&P Energy Index, which includes oil service companies and E&P companies and other kinds of companies. It tracks very closely WTI production, and that's pretty significant. Again, the idea is why not get production and price rather than just getting price alone? Because ultimately, if the price stays high enough for long enough, production is going to catch up, and you're going to get this. And if this is really an investment and not a pure sort of speculation, then one wants those long-term cash flow streams that happen after production increases. So let's look at some other charts here as well, going back to equities versus commodity derivatives. Let's go to the next slide. And if one looks at the 10-year return here for the CRX, again, just a basket of various commodity equities versus the derivatives, you can see the various benchmark commodities. You can see the S&P 500, and you can see the UBS and the GSCI, and the total returns for the commodity derivatives indexes are much less than that of the commodity producer equities. And this is for 10 years. Let's go to the next slide, which is 5 years. And here you've got a situation where you've got the S&P 500 that recently has done better, but by and large the commodity returns are much better even in 5 years than the benchmark returns and commodity indexing. And again, you get the volume growth. It's not just price. You also get volumes. And so, but there's other issues as well that I'm going to go into the next few slides. So let's go to the next slide, slide 13. And here's just a chart that sort of is illustrative of what's happened in these various index and various Sharpe ratios below. And if you think about it, if you buy a portfolio of equities that benefits from volume and price, that's a much different situation than constantly rolling a portfolio of commodity derivatives to deal with the futures markets that after all expire either monthly or quarterly, as the case may be per commodity. So if you think about this for a moment, you can invest in a commodity equity and the agents get effectively one commission. They get paid once. Or you can invest in a swap, at which point in the GSCI there's 25 commodities. They're rolled roughly, bought and sold roughly at a minimum 4 times a year, but many of them are 12 times a year, so roughly 150 transactions. So if you think about, maybe why an agent would market one versus the other, there are some economic reasons from the agent's perspective on maybe why they would consider marketing that. You've got a significant amount of transactions versus really just one transaction. Let's go to the next slide. And this is a real key here. This is as investors have actually moved into this space, our view is that they've actually changed the roll phenomena as well. And if you look at the GSCI total return, you look at the GSCI loss created from roll yield, it's quite significant. So even though you've had positive absolute price performance in many commodities over a period of time, you've actually lost overall because of the role. Because of this, if you're synthetically storing these commodities via an agent who then has to have physical storage. So if the market's in contango, which many of these commodities have been in contango over this period of time, and not in what they call normal backwardation, then every month you lose from roll yield as you roll forward. And it's not surprising that around the same time that commodities were invested in some of these markets turned into roll yields where they actually forward yield curves where they actually had a contango state. A contango simply means that the commodity yield curve goes up in the future versus down, which is backwardation. As that happened, then it's not surprising that large Wall Street firms would buy physical storage to accommodate the cash and carry hedges that they would do to take the other side of pensions and other institutional investors that were invested in commodity index products. And all of those storage profits, effectively, that were paid by pension funds ended up going to the person that owned the storage, which in this case was the street. And so that's something that I think is quite significant. I'm not sure that I think the understanding of roll yield is much better understood today, but I still think that it's not as understood as well as it should have been, and the cost can be quite significant. Let's go to the next slide, please. And this just actually came out of Bloomberg about 6 weeks ago or so, and this is really talks about just the fees and commissions that are generated from managed futures products, which are another way of allocating to commodities. Also are quite significant. And again, it goes back to this idea of whenever you're getting involved in the derivatives markets, which are constantly expiring because of the nature of these commodity futures derivatives were developed for hedgers, for bona fide hedgers, to be able to hedge their production and to potentially take delivery on a fairly regular basis during the calendar year. They weren't really ever designed for large-scale institutional investment. There's a lot of fees that go into part with the constant transactions that are necessary in order to sort of manage to have an ongoing derivatives portfolio via the futures market. Let's go to the next slide. And so clearly, this slide really just talks about modern portfolio theory. You've had a situation where you've had enough investment into these markets where you've actually changed the structure. The correlative benefits that used to exist before the investment, maybe when David Swinson was investing in commodities in the 90s and there weren't many others like him, as large-scale investment came into these markets, they changed themselves. And so not only do you, in many of these markets, have you not seen normal backwardation, which is the state of the markets what you normally saw. Now the state often is more like a normal contango. And you've had a situation where you've got poor absolute returns because of the roll yield and because of the constant transactions that are necessary in the total return swaps. But you've also got a situation where you've got the correlation that's been much more like capital markets, and so that benefit is gone as well. And of course, modern portfolio theory requires both. It's not enough just not to correlate with market shoots. You're supposed to have positive expected returns. Let's go to the next slide, please. And this is a I think should be a pretty self-explanatory slide, but I'm always surprised when I go and talk to people in the academy that this particular concept is not understood that well. There's been a buyer and seller for every transaction in history, and we know that. And so you'll hear people say, well, I'm buying, there must be a seller, and that's the case. But the market just moves via price. The only thing the market does is allocate via price. And so if you're a buyer and there's no supply, the market has to move up. Its function is to move up in price until it can send enough sellers to take the other side. And so, and that's the same with whether it's futures contracts or stocks or whatever else. People say, well, there's an infinite supply of futures contracts, and that's absolutely the case, but there's not an infinite supply at a given price. There's a finite supply at a given price. After that, the price has to move to incent new sellers. And so clearly, with market mechanism, the way this works, whether when you get money coming into a market, you're going to get price movement. And let's go to the next slide. And this is just this talks about this more from a larger perspective rather than necessarily from the principles perspective. Let's go to slide 19.
Mike, maybe we want to pause and see if anyone has any questions right now.
Sure. Yeah, that's a good idea. I'll just pause right here.
Great. If you have any questions, just type them into the question box, or you can raise your hand and we'll unmute your line and you can ask your question directly. Mary, you seeing any questions?
No, I'm not receiving any questions right now.
Okay, I'll pause for another couple seconds and then we'll move on, Mike.
Okay.
Okay, let's continue on.
Wait, I'm sorry. We have a question.
Okay. All right.
Let's see here. Okay, we have a couple questions.
You can read them out, Mary.
Okay. Let's see. First one. Very interesting pitch on equities, but regarding futures, correlation is not causation. Why are people so concerned with index funds? To my knowledge, all they are doing is to buy into the second or third contract on the futures curve. After a month or two, depending on commodity, the position is rolled over by selling the old contract and buying a new one further out the curve. Index funds are therefore not net buyers of commodities. They regularly have to sell futures as well. And their presence in the market could only eventually affect the shape of the futures curve, not the spot physical price. Where is the academic research pointing to an eventual link between futures and physical prices?
Okay, well, let me just address a couple of those things. So there's several issues there that the question raised. Number one is there's two impacts on price. There's the impacts that the initial investment happens, and we're certainly not saying that there's an impact on the price after that in the sense of on the absolute price, but only on the curve itself. To the point of the question. In other words, there's two impacts: when the money comes in initially, and then secondarily on the yield curve as it goes forward. So the roll yield. So the constant rolling of the commodity contracts in large enough size actually affects roll yield. It actually affects the curve, the forward curve. It certainly is not the only factor in the forward curve, but it is a factor. And the initial investment is what actually affects absolute price. And again, the only reason the initial investment have anything to do with price is if $1 billion comes in the market and it has to buy X amount of commodities, then you have to incent sellers to take the other side of that trade. And you will incent them, but you incent them via price. And then going forward, each time you roll, you have an effect on the shape of the curve, but not on the absolute price, just on the shape of the curve. And so in terms of academic research with regard to that, we're going to go into that later. I've just stopped, I won't go into that there because I'm going to let David sort of go into that later in the presentation.
Great, thanks, Mike. Mary, were there other questions?
I have one more question.
Great.
It is, with many investors leaving commodity indexes, do you see prices continuing to fall?
Well, I think the question is at what rate. I think at what rate? As investors leave these markets, it's going to have the opposite effect on price. The question is at what rate? I mean, what rate I should say. what you don't want to have is a situation where everybody withdraws at once and you have sort of a crash. You know, the ideal thing is for people to gradually remove their investment in commodity indexes and look at some other way of allocating to commodities. And our view is to suggest equities, but certainly there's other ways of accessing those markets that may have, you know, again, going back to accessing the means of production rather than just speculating in the fruits of production.
Good, thanks, Mike. So let's continue on with the presentation.
Okay, so and this is a chart of commodity index fund investments, and to the question before, you know, we've heard this a lot. You know, inflows don't necessarily create causation, or correlation doesn't necessarily imply causation, and we're sympathetic to that. But basically, the situation is even if that's the case, it's when you look at the charts and you look at the amount of inflow and so forth, and the gross price performance, in our view, it's still hard to argue that it's had nothing to do with it. Our view is that while it hasn't been the only issue, it's certainly been a contributor to the issue. And if it's been a contributor to price formation, which we believe strongly it has been, then, you know, again, you know, what you know, how do we look at that, and how do we consider that from a larger perspective? You know, what should we do? What should someone in a poor country do that's on a fixed income, that has to deal with the asset allocation activities of investors? You know, how long should they wait, and what's the price increase that they have to deal with to accommodate the allocation desires of large-scale institutional investment in commodity indexes? That to us is the bigger issue. And let's go to the next slide. And here's another way of looking at you know, commodities and their share. We're just going to look at open interest in terms of the overall state of the market. Open interest effectively is just sort of ownership of the market. It's the outstanding contracts. You know, when you enter in a contract, there's a seller on the other side. That contract, what represents one contract of open interest. And traditionally, speculators were there to provide, and they were oftentimes local, so they were hedge funds, CTAs, etc. They would collectively were around anywhere from 20 to 30% of open interest, and hedgers were the other 2/3 to 3/4 of the market, and that state of affairs existed for a long time, really until the early 2000s. So here's a market share. 1993 CBOT wheat average market share, and you can see that specs were the clear minority of open interest. And
Larry, if you just want to hit the button, it'll pop up the chart there. Yeah.
Can everybody see it? I'm on slide 20.
Yes, we can now, Mike.
Okay, and then if you look at the lower part of it, you can see where speculators are now in 2013 the dominant participant in open interest. In other words, hedgers are a minority, and so there's this question of, you know, liquidity. You know, you need speculative liquidity, and we're sympathetic to that. You do need sympathetic or speculative liquidity. The question is how much liquidity does one need? And that's really the issue. It's a question of degree. Again, I mean, if one takes 2 aspirin, one gets one effect. If one takes a whole bottle, one gets another. And so there's a need for liquidity, but there's not necessarily a need for majority ownership in terms of open interest in the market by the speculative community, because clearly the market is going to move more based on factors that are important to them, not necessarily just supply and demand issues, but other issues as well. For instance, allocation changes and so forth. To one of the questions earlier. So let's go to chart 21. And you can see the speculation. This is percentages versus volatility in CBOT corn from 95 to 2010. And over a longer period of time, coincident with the increase in speculative percentage of open interest versus hedging, you've seen an increase in vol. I mean, it's a tough chart because vol is affected by many other issues, but there's been a gradual increase in volatility. And volatility is a tax, and this is actually opposite of what sort of efficient markets would suggest, which is, the more speculative liquidity you have, the less volatility you have. And so what we're saying really is that you can actually have a state of affairs where the speculators are running the asylum effectively, and you get more volatility than you would get otherwise. And of course, this was also addressed in a question before. What happens in the futures market? It doesn't stay in the futures market. And if you talk to commercial traders, whether the grains or the energy markets or anywhere else, they've always got charts and Bloombergs with the futures markets on them, because the futures markets are used as a benchmark. And again, that's a different thing. That's not the classic idea that futures have to convert to spot. Actually, because the futures markets are so much more liquid, so much larger, actually people price versus the futures market, and so and they become effectively basis traders. So you've got traders around the world that are using the futures benchmarks, for instance, in oil, either TI or Brent, and then they're pricing it off some basis differential for their own spot grades. And so the spots move around, but if ceteris paribus, if the futures market moves up $1, your spot is going to move up $1 as well. Again, ceteris paribus for basis differentials. And so that's how these things are transmitted, because everybody uses them as reference prices for their hedges. Even if they don't take delivery, they're used as reference prices. And once they become reference prices, then by custom, they become the actual price that matters for the pricing of actual physical commodities. And that's actually, Platts and other people that actually use these prices, of course, use near-month futures as a key component of their own pricing. So I'm going to turn it over to David Frank, and he's going to talk about academic research and some other issues with us, and we'll go from there. Thank you.
Thanks, Mike. So, first of all, this slide here, I think, actually does speak to one of the questions we had, which is to say, okay, maybe there has been a big shift in commodity futures, but aren't commodity futures, after all, just a derivative market? What impact does that really have on what we care about, which is the price of actual commodities, food, energy, and so on? And the key here is that actually the futures market price, as Mike just mentioned, does provide the primary benchmarking for the physical markets. And that's why the futures market is so important to protect from factors that could actually cause it to stop working properly. So in the first place, futures market is a benchmark price when it comes to physical auction processes. If you're, that's one of the whole reasons they exist, right? It's not just for people to be able to hedge. The whole idea was that if you have farmers distributed around a region and they're negotiating prices on a bilateral basis, how do they know if they're getting a good deal or not, right? If you're a farmer, are you really going to be able to invest in all kinds of infrastructure in order to be plugged into market conditions all around you, or is it more convenient if you can just look to a single exchange and say, okay, I get it, the price of corn today is this, the price of hogs today is that, and so on and so forth. So that's how these markets evolve. So that means that a farmer who is entering into a negotiation on corn or wheat, they're going to actually be looking at the Chicago price of wheat, which is the futures price. So if all of a sudden you have a huge amount of institutional investment that changes that price, then that also changes the terms on which that farmer is going to be able to negotiate. And it's not even just in the United States that it has that impact. Because, in fact, international grain prices will look to the largest markets, right? So they might look at the Paris wheat price, they might look at the Chicago wheat price in order to actually even do their local negotiations, because we do have international trade, obviously. And so if you're a large international import-export company, you're not going to want to pay over the odds in your local country when you know you could go to Chicago and get a better price, or even potentially not even go to Chicago, but just buy a futures contract and do an arbitrage that way. So that's one of the three ways, okay? But the second way is even more direct than that. So many commodities primarily trade through physical term contracts. And what that means is, again, let's just take a farmer. Say you have 3 harvests coming up, or 2 harvests, however far ahead you want to go. Let's just say 3. Do you really want to be in a position where each time the harvest comes around, all of a sudden you have to start from scratch and try to market your product? I mean, that just seems like a wildly imprudent thing to be doing, unless you have no choice. Wouldn't it be better if you could enter into an agreement with a purchaser that says, we're going to do this quantity for the next 3 harvests? Well, yes, it would be much better, and that's why this is a very common way of doing these transactions. You're not just going to the market every day and seeing what you can hawk on the fly. You're actually trying to lock in a constant supply chain, or a constant purchasing chain. Well, what's the benchmark you're going to use for that? Obviously, it's going to be the futures price, because it's the big, central, supposedly accurate price. So what these guys do is they negotiate a basis trade, or a basis contract, which says, okay, here's the volume we're going to transact over the next 3 harvests, plus or minus a certain amount that you can tell me a couple months in advance, and we're going to price it based on the Chicago wheat price plus, 50 cents a bushel or something. Okay, that means if the futures price between now and then goes up, then the actual physical price at which the transaction ends up being made goes up by the exact same amount. And then finally, and this is more specific to energy, you have the assessed prices that Mike talked about. And assessed prices, I mean, it's had a little media coverage recently because it is sort of controversial, because essentially what you're saying is, hey, we got billions and billions of dollars of trading, and we need some price to settle it all against. How are we going to do that? Well, let's just hire some guys to kind of figure it out. And you can see that there's obviously potential for manipulation and so on, and question marks over whether these reported prices or these assessed prices have been accurate or not. But if you actually look at the methodology that these firms use, like Platts, what they do is they try to look at, say, jet fuel on the Gulf Coast, or they try to look at actual petroleum, actual crude oil in in some other part of the country, and they try to see, okay, well, what was the the typical price at which that traded during this window today. And whatever that typical price was, we're going to go and tell everybody in the market the price of crude oil today or the price of jet fuel today was X. Problem being, that window all of a sudden becomes very high stakes. A lot of people might not want to trade during that window because it's going to have all kinds of ramifications. If they influence the price, it may cause problems for them. Not to mention the fact that plenty of people aren't going to want to trade during that window just because their trading happens when it happens. It doesn't, they don't want to have their trading behavior dictated by some arbitrary window slice. So there are plenty of times when that window where these prices are supposed to be assessed, there's almost no liquidity. There's basically no physical trades going on, or very few, or some that are so crazy that they just, they don't even look representative. So in any of those cases, which is frequent, Platts has to come up with a number. Everybody's waiting for them to tell them what was the price of crude oil today. So where are they going to look? Well, you guessed it. Obviously, they're going to look at the futures market price. So even in these assessed prices that are supposed to keep the actual physical trading as some kind of beacon of price transparency, even in that case, they're really using the futures market as a primary mechanism to determine what the price is. So that's really a key way in which the futures market affects physical prices. And just one last one, which is a little more technical. If the commodity index funds are indeed pushing the forward curve into contango, which, as we'll see later on, it's been established that they are doing that, that changes the incentives for producers and consumers. Think about it. If you're an oil producer, for example, and you can see that there's a forward price curve in contango, that's telling you the price of oil 6 months down the line, a year down the line, is going to be higher than the current price. It's even telling you that you could actually lock in an arbitrage if you don't sell your product now, but instead sell a futures contract against it and then wait. So what it actually does is it incents everybody to hold their product off the market and wait, which becomes a self-fulfilling prophecy, right? Because then you're reducing supply, which pushes price up. So an index fund can actually cause prices to rise by pushing the curve into contango, which is a prediction that prices are going to rise, but is really just an artifact of their trading, and then making it a self-fulfilling prophecy by changing the incentives of producers. So that's a little more technical, but that's yet another way in which all of this stuff does feed back into the physical market and even come to dominate it. But let's move on from that and just quickly go through some of the academic research on this, and we can skip ahead one more. Okay, so you know, much is made of the fact that there are plenty of studies on both sides of this debate. Right? You have studies that say, no, there's no evidence that speculation in general or index funds in particular influence prices. On the other hand, there's a bunch of studies saying, yes, they do, we found evidence. And the mistake I think people make is that they say, well, okay, there's 12 on one side, 12 on the other side, it's a wash. But that's not how these studies actually work, right? There's 3 listed on the left there, which are famous, often cited as classic studies that found no evidence that these things influence commodity prices. And I've just put 1 on the right, even though there's plenty more. Because the point I'm making here is that you can have a dozen studies on the left saying they didn't find any evidence. But when one guy on the right does find the evidence because he looked in the right place using the right tools, that closes the debate, right? I mean, if you have a dozen physicists trying to find a new particle and they don't, and then one new guy goes out and finds the particle, you don't say, oh, well, actually, sorry, there's 12 against 1 for, so the particle doesn't exist, right? I mean, you give the guy a Nobel Prize. So this is the situation we have here, which is that it's true, plenty of academics, many of them directly or indirectly hired by the financial industry, but that's another matter, but plenty of them didn't find any evidence, but now several of them have, and so we have a situation where the particle has been discovered, the causal chain has been identified. Specifically what Ken Singleton did, who's out at Stanford, he just changed the time period. So Irwin and Sanders et al., they'd been looking on a 1-week basis or something. They'd been saying, okay, when we get some new commodity index flows coming into the market, do the prices change within a week? And they found no. The CFTC actually looked at this using better data, which they have, but it's non-public, so the academics couldn't use it. And there was reason to believe that maybe actually there is an effect even on a 1-week basis, right? But you need better data to be able to prove that. But what Singleton did was he said, okay, I'm going to use a 13-week period, and what he found was that over a 13-week period, yes, there's a clear relationship between index flows and prices, even when you control for supply and demand, you know, geopolitical things, all that sort of stuff. So it's still robust to all of those things. Okay, let's skip ahead. Okay, and here's another example. Okay, Ethan Moo, 3 years ago, he also found that there are, and so Singleton was looking at the absolute price impact that Mike alluded to earlier. Moo was looking at the change in the shape of the curve effect. Remember, those are the 2 ways in which the commodity index funds influence prices. And what he found is that if you look at the Goldman Sachs Commodity Index, you have persistent price rises, but importantly, widening contango every month during the 5-day window in which the GSCI gets rolled. And he found that for every single commodity inside the GSCI. And he found it for 0 commodities outside of the GSCI. So I agree that correlation does not imply causation. However, when every single case of a hypothesized causal factor was correlated with a positive test result, and every single case of a commodity where that putative causal factor was not present was associated with a negative result, I think that's very, very strong evidence that there is, in fact, causation. Okay. And what he concluded was that this stuff's going on, and you might hope that arbitrageurs might come in and bring the markets back to their perfect, efficient level, but they're unable to do so, because we don't live in a textbook. We live in the real world where there are transaction costs and risks and so on and so forth. So that's another great study. Okay, let's next slide, please. And there's plenty of others. This is just one example that came out last year that actually looked at commodity-linked notes instead of index swaps. And just to summarize, they found direct evidence of the impact of financial trades on commodity futures prices. And what they found was when, say, a bank issues a commodity-linked note, right, which was the whole point of a commodity-linked note is it's just a different way for an institution to invest in this stuff. These guys found a statistically significant, monotonic, persistent impact on commodity prices. Okay, meaning that there was basically less than a 5% chance that this was a random effect. It was monotonic, so the more commodity index trading or more commodity-linked note trading there was, the bigger the effect, and it was persistent through time. It wasn't just a one-off thing. Okay, and then next slide. And here's just a few others. Cheng, Kirilenko, and Wang, Hamilton and Wu, Sam Williams. I mean, there's just a list of them there, but and they find evidence to varying degrees, right? For instance, Hamilton and Wu, they say yes, it had a big effect 2007, 2008. Didn't have much of an effect 2010, 2011, whereas others find a more persistent effect. But if you really want a comprehensive list, then there's a URL that you can click on there that has about 50 or 60, maybe even more now, because that was back in 2012. Okay, and let's skip ahead to, I think, the last section. Yeah, I mean, I think we can just briefly go over this slide, but the point with this one is just to say that, look, to summarize all that academic research, what it shows is that you shouldn't be misled by the labeling of a commodity index investment as passive. It's not really passive. What it is programmed. In fact, it's very active, because even after you've invested the first time, now you have to keep on rolling month after month after month. And what makes it particularly problematic is that the activity is not random. It's predictable, meaning that in the textbook, it gets arbitraged out. Okay, but in reality, it maybe even gets amplified by momentum traders. Okay, it's not based on fundamentals, meaning, even in the textbook, that's a bad thing, right? But in real life, essentially, you're causing producer and consumer incentives to get shifted away from where they ought to be. You're incentivizing, a huge amount of investment. For example, right, like the people who, and I don't want to get into this whole debate right now, but people who are interested in sustainable energy sources for the future. Okay, well, what happens if this speculation pushes the price of crude oil above $100? Now, all of a sudden, you can make money producing crude oil in really expensive ways, which may be expensive financially, but also environmentally, right? So now you go out into the into areas where crude oil is harder to extract, may have a more damaging impact on the environment, but because the index funds have pushed the price up so high, it's actually economical for you to do that. This is if the price of crude oil was lower, where it would be normally, then you might go about investing that same money into other forms of energy. Okay, so that can be deeply problematic. This is large volumes over short periods, which, as any institutional investor knows, is a recipe for disaster. And it invites volatility trading, as I said, because it's not random. So it's creating volatility, which incentivizes momentum traders to come in and actually amplify the effect. Okay, and then let's skip to the last section. Okay. So, the Harvard Initiative for Responsible Investment, they had a big colloquium, a bit like what we're doing right here, and, they boiled it down after hearing from academics, money managers, other experts, that really passive commodity indexes are trend followers. They may contribute to speculative bubbles, and really, half the time they're not even aware of many of the things that are going on here. And next slide, please. Okay, and so this is the last section here, the regulatory developments. Just one last thing to kind of wrap it all together, which is to say that, this is something that the regulators, the legislators have taken a look at, and there's some uncertainty at the moment, but it could well be the case that they're going to actually start to prevent people from doing this to the degree that they've been able to do it so far. In other words, the CFTC, the regulatory agency for commodities, they were given the power in 2010 to actually basically say, no, you can't do this anymore. That's because Congress held a bunch of hearings and they decided there was enough evidence of a problem here that really they needed to hand off to the regulators to decide what to do. After 3 years of political wrangling, lawsuits from industry, huge lobbying efforts, there's now a new position limits rule which would limit speculative activities. And depending on how that rule actually shakes out, there's basically a big regulatory risk as well for anybody who's going to be investing in these things, because it could just be that the plug gets pulled on that, which I think is just further evidence that there really is some interest or some belief that that there's a major problem here. So why don't we open it up to a few more questions, because I know that we're getting close to running out of time here.
Sure. Thanks, David. So if folks have questions, you can type them into the box, or alternatively, you can raise your hand and we'll call on you. And Mary, if you're seeing any questions, you can go ahead and read them out.
Don't have anything yet. Oh, wait a minute. Okay, we've got a couple of questions. Will the new limits be low enough to affect these problems?
Yeah, that's a great question. And at present, according to the proposal, I would have to say that the limits would, when you combine the level of the limits with the way that they're going to be aggregated, no, they would not be low enough, because essentially they as currently written, the position limits limit you to 2.5% of the open interest. And that sounds great, right? Because as you saw, in many cases the speculators are 65%. But the 2.5% applies to any one of these funds. And there are dozens upon dozens of them. So in reality, what you really need to do is aggregate all of the funds that are following the identical strategy of following the GSCI or whatever. You need to aggregate them as one trader, which they have the legal authority to do. Congress explicitly gave them that power in the Dodd-Frank Act. So if the CFTC decides to do that, which obviously we've said that they should, then yes, it would be able to solve the problem. Even without making the limits smaller, just by aggregating properly.
Okay, we have another question here. How might the new regulations affect us as investors?
So here's one example of what could potentially happen. Right now, it's not clear for an index swap who is going to be subject to the limits. And bear in mind, if you're investing in commodity equities, these limits don't apply to you at all. But if you're investing in commodity derivatives like an index fund, one of two things can happen. One is the CFTC might decide that as the ultimate investor, the position limits pass through to you. And basically, if they decide that, number one, the limit passes through to you, and number two, you're going to be aggregated with all the other investors who are doing basically the same strategy. You know, there could be, number one, a reporting requirement that could be, you know, a surprise and a burden to you. But number two, you may suddenly find yourself in a situation where you had allocated, put in the resources, and now all of a sudden you actually have to scale all that back dramatically. Now, I'm sure they would not implement it in a way that would cause everybody to have to draw back suddenly, you know, so that they would all get completely rinsed, but probably the way they would implement it would be some kind of freeze and then some kind of scaled reduction. Nevertheless, it would just be not a very fun situation to be in. The other thing that could potentially happen is they could decide, okay, these limits don't pass through to you as the ultimate investor. Instead, they apply to the fund in which you're an investor, meaning that now, you know, basically it's up to the fund to decide what they're going to do. And, you know, I would be maybe more concerned about that, I don't know, as an investor, because now all of a sudden you have a fund manager who has had to freeze his investment and figure out a way to get out of this over time. You know, who knows what he's going to end up doing. So either way, I think you could end up in a thorny situation if they do decide to go ahead with this. And so my take on it is, why open yourself to that kind of regulatory risk? To being in a situation where either you have to freeze and then withdraw from an allocation you made, or you're actually at the mercy of a fund manager who I'm sure isn't going to want to ruin his relationship with you, but basically, you know, is in a pretty dire situation himself. So either way, I think it's a risk.
Great, thanks, David. And I think we have a challenging question that's come through on the line regarding one of the research papers, particularly Wang's conclusions. And one of our attendees is saying that there's a revised paper as of May 2013, and would like for you to comment on that.
Do you want to roll back a few slides to where we had those listed out? And then the Henderson, Pearson, and Wang. Yeah, and you know, I haven't read the May version, but as far as I'm aware, there's no. I mean, you know, like I say, I haven't read it, but I would expect that if the conclusion had been reversed, then you know, I would know about that. But it's quite possible that they may have said that the effect only worked up to a certain point and then stopped working. But is there anything more specific about what changes were supposed to have been made?
Sure, I can read that out. Our overall conclusion is thus consistent with the most previous literature. There seems to be little evidence that index fund investing is exerting a measurable effect on commodity future prices. As noted in the introduction, even if one could demonstrate the effect of index fund buying on commodity futures prices, it would be a separate challenge to explain how this could end up changing the equilibrium spot price. We conclude that it is difficult to find empirical foundation for a view that continues to have a significant impact on policy decisions.
Gotcha. Yeah. So that's not actually a revision of the findings, right? That's the point that we spoke to earlier. What that's saying is we found that these investments affect futures prices. And we just want to clarify that we're not saying that that necessarily means that they impact spot prices. And so, you know, what we argued is that, well, of course it affects spot prices via all the mechanisms that were just listed in that other slide, you know, with the flow chart. Right, so what they were clarifying there, it seems pretty clear to me, is that yes, it is hard to measure the impact on spot prices, like directly the causal impact, because the impact is one step removed, right? Because it goes via the futures market. But they're not saying that they didn't find the evidence that they found, right? They actually did find the evidence of the impact on futures, and they say, well, it's up to other researchers to prove that actually has an impact on spot prices. So that doesn't actually change the implication.
Great, thanks, David. And as a follow-up, if things are not random but programmed, shouldn't it be easier to arbitrage? Right.
Well, yeah, you would hope so if we lived in an efficient markets universe. And I think what this demonstrates, I mean, I don't think there are many people left who actually believe that we really do live in an efficient markets universe. I mean, you know, Fama, right? He just got the Nobel Prize along with his sort of arch rival, right? Who had these entirely different views of how markets function. But the diehards like Fama, he said, no, the financial crisis was efficient markets. It was just pricing in new information, which seems like a pretty bitter pill to swallow. I think most people recognize that, you know, what we saw in 2008 was a mass-scale market failure. And so, you know, but nevertheless, right, it's true that arbitrage clearly exists in some degree. And so what I would say is given that you would assume that non-random trading would invite arbitrage, and given that we know that this stuff is not being arbitraged out, right, from Moo's study and also from some research that we published, what does that tell you? It tells you something about these markets. It basically tells you that they have become more of a casino than a traditional marketplace. In other words, there are more people out there with the money to actually, you know, move these markets, follow trends, jump in as momentum investors or momentum traders, and there's more activity going on from actual pre-programmed trading than from people trying to arbitrage. You know, essentially the arbitrageurs tried and failed. It was like a salmon swimming upstream. And that's deeply problematic because essentially the exact opposite of what you would hope has happened. Instead of these price anomalies being arbitraged out, they've maybe even been amplified by people deciding, well, look, if you can't beat them, join them.
Yeah, David, I would just make one other point. This is Mike. I mean, of course, there's limits to arbitrage, and you're talking about, you know, $200 to $400 billion of index investment that has to be rolled. And again, I mean, even for large-scale prop desks around the street, which have been scaled down significantly because of other regulations, it's hard to imagine that you could have enough arbitrage pressure to really offset all of those spreads. But it is interesting because it has persisted in spite of I'm sure attempts to remove the you know, the premium in the roll.
Another question. If effective position limits and aggregation are applied, how will high-frequency trading affect the commodities market?
Yeah, unfortunately, the position limits wouldn't really affect HFTs because HFTs end the day flat. And the position limits apply to positions that are held overnight. So in other words, the CFTC has to do something entirely separate if they're going to go after high-frequency traders, which really they should as well because, you know, there's no doubt that the HFTs have had a growing impact on this. And like I was saying before, that you have the momentum traders coming in to actually, who actually exaggerate these moves instead of arbitraging them out. You know, HFTs have got to be part of that. You know, maybe even a huge part of that. So the CFTC just put out a concept release. You know, we're submitting a comment to them, telling them that they ought to put in, for example, minimum resting order times of a second and do various other measures. But the position limits themselves won't affect the HFTs, and that could be another year before we really see any meaningful action on HFT.
Great, thanks, David. Any other questions on the line? Again, you can feel free to type in or raise your hand. I think, David, we also had another follow-up question related to research and related, could we see meta-studies rather than single studies? Are there any studies on the existing studies?
Yeah, I mean, you know, you get these surveys of the literature, right? And I mean, part of the issue is that they're usually commissioned by somebody who has a vested interest, right? So even the ones that are kind of pro-position limits and really believe that there's an impact, you know, maybe they're commissioned by an airline who's affected by this, and then certainly all the surveys of the anti-position limits literature, they're usually commissioned by, surprise, surprise, someone who is heavily involved in promoting index funds. So those definitely exist, but I'm not personally aware of one that is really, super compelling and able to be impartial. But again, I would just sort of emphasize that you can survey the literature, but the key is to realize that even if you have a bunch of studies on one side and a bunch of studies on the other side, not all those studies, it's not just a balancing act, right? You don't just weigh the pile of paper, right? Like that's not the evidence, is not the weight of the paper. It's actually the the contents of the paper. And so when Singleton found this effect that was persistent at these 3-month time periods, that's evidence. That's been found. That shows the effect is there. So I just think that's important to bear in mind.
And David, I would just say I think there has been a study, and I forget who did it, and I think we actually talked about it in the last month or so, and I think it was a Kirilenko study, but I'm not certain. I know he had partners on it, maybe Wong, or I don't know who the co-academics were on it, but it looked at an overview of the literature, and I think its conclusion was that that commodity index speculation was a factor. It wasn't the only factor, but it was one factor in the pricing of these markets. And I just can't remember the paper. I don't know. I think we talked about it, but it's literally I think in the last couple of months.
I think we have one last question here. Assuming that there were a large number of naive investors who entered the commodities market despite its poor return prospects, wouldn't we expect a significant drop now that more historical information is available? In other words, is the speculative boom over, and should we expect more stable pricing going forward?
This is Mike. I would just say that I think over time you're going to, that's sort of the classic phenomena. I mean, you get a speculative inflow, and then you get an exodus over a period of time. So it's interesting. I think the longer these these kind of characteristics of these markets persist, especially relative to other items that one could invest in, I think that there'll be less and less desire from new investors to come in, and I think investors that are presently in them will continue to wonder whether or not they should continue to be involved in them in the present form.
Great. I don't think we have any further questions.
Great. Nadira, this is Kate. Sound good to close out?
Yes,
Yeah.
Thanks, Kate.
Okay, great. Just in closing, first like to thank our esteemed presenters, both Mike Masters and David Frank, for speaking to us regarding these social and financial risks for investing in food commodities. In addition, I'd like to thank UNPRI and our guests on the call, and Mary Vicari and Nadira Narain of ICCR for their dedication and support in this issue. If any of our participants have any further questions, I'd be happy to either answer questions myself or direct you to the right person. My email is kwalsh@tricri.org, so that's kwalsh@tricri.org. And thank you all for joining today.
Great. Thanks, everyone.